In this video, we're going to discuss the periodic inventory system. So with the perpetual inventory system, we were talking about continuously updating the inventory account every time that we buy or sell inventory. But with the periodic system, it's different in that we're going to wait till the end of a period, for example, the end of a quarter, the end of a year, and then we're going to do a physical count of the inventory and determine what inventory is in order to know what the inventory is, and then we can go and calculate what the cost of goods sold is and so forth. So we're going to do a count. We're going to do a count at the end of the period. So let's jump into an example. It'll make it a little easier for you to understand. So let's say that you have beginning inventory, 50 units, and they came in at a cost of $5 a unit. So it cost you $250 to buy this inventory that you have on hand. So this is what you start with. That's your beginning inventory of $250. And then you go and you make a purchase. You buy 800 additional units of inventory, and that's at the same cost. It's at $5 a unit. So just take the 800 times $5, and that's going to be $4,000. Now, whereas with the perpetual system, we updated our inventory account directly, now we're going to update a different account. We're going to do what's called purchases. We're going to debit purchases for $4,000. We'll deal with this purchases account later. So if you're worried and thinking, well, what is this? Don't worry about it just yet. Let's say you paid cash for the inventory. So we're going to credit cash for $4,000. And I'll show you what we do with this purchases account in a moment. But for right now, just know that we're not actually making a journal entry to the inventory asset account, right? This is our journal entry right here. So now we go and we make a sale. So we sell 750 units of inventory at $12 a unit. So similar to the perpetual method, we are going to debit accounts receivable, and we're going to credit sales to record this sale. And it's 750 times $12 a unit. That's $9,000. So we'll be debiting accounts receivable for $9,000, and we'll be crediting sales for $9,000. But now notice here, so with perpetual, we also made a corresponding entry where we debited cost of goods sold and credited inventory. But here, with periodic, we do not have that entry, right? So we don't have a cost of goods sold entry right here. So this, we're done when we make the sale here, when we're using the periodic method. So you say, well, where does the cost of goods sold and all these things, what happens here? Because we're not making that entry. Well, at the end of the period, we're going to go and count. We're going to actually physically count up, or maybe we have some system for counting our inventory. Every firm is different. We somehow count and get an estimate of how much inventory that we actually have on hand. And so we do that count, and we say, okay, look, we went out. We had some people actually count the inventory. We have $500 that's in our ending inventory. So now we can set up an equation to figure out what our cost of goods sold was. So we take, here's our equation. So we go 250, and that was our beginning inventory. I'll just put BI here. And then we add the $4,000 in purchases, and then we subtract X, right? And I'm going to explain that in a moment. And that's going to equal our 500 ending inventory. So think about it conceptually like this. So we've got, here's our purchases. So we've got our beginning inventory. This is what we start with. And then we add something to it. We add the purchases. And then we subtract something. What is that? That's going to be our cost of goods sold. That's going to be our cost of goods sold, right? And then whatever, so we have what we start with, we have what we add, and then we have what we subtract, which is the cost of goods sold, and that gives us our ending inventory. So that's our equation, and we can just go ahead now and solve for X. So if we just solve for X, we're going to have X equal to 3,750. And if you don't know how to do that, you just add X to this side over here, add X, and then subtract 500 from the other side. So in any case, that gives us 3,750. So that is our cost of goods sold. So I'll just put this in parentheses to emphasize that. That's our cost of goods sold. So now we have to make an adjusting journal entry, because remember, unlike perpetual inventory method, we haven't been adjusting our inventory asset account throughout the year. So now we have to make those adjustments. So what do? Well, we know we have cost of goods sold of $3,750 and we didn't make an entry for it before. So we're going to debit cost of goods sold for $3,750. Now remember that purchases account? Let me come back here. Remember this? And we say, hey, we'll talk about this later. Well, that's not a real account, right? That's just a temporary account that we use to track our purchases. It's not a real account in the sense it's not going to go on the balance sheet and be permanent. So we got to zero that out. So what we're going to do, we debited it to increase it. So we're going to credit it. We're going to credit purchases here to decrease it, to zero it out. Credit it for $4,000. Now you notice our left and our right side do not balance here. There's a difference of $250 between these two numbers. So what does that represent? Well, it actually represents inventory. There's a debit to inventory of $250. Now you could look at this as that this was the plug to make the entry balance, or you can think about it like this. So our ending inventory is $500, right? And we know that from our count. We did a count. We have $500 at the end of the year or quarter, what have you. And we started with $250 of inventory. So we start with $250, we end with $500. So since we didn't adjust the inventory account anywhere in between here, we just have to look and say, look, we went from $250 to $500. Well, we had an increase then of $250. We just take what we ended with and subtract what we started with. 500 minus 250 is 250. So this is just saying here that our inventory went up $250 during the year.